Are you diversified or not? A look at the portfolio of a portfolio manager tells a lot about their personality, and in particular, the question, are they diversified or not? This is a Not Even Wrong podcast. It's October 5th, 2020. This is Krim Delco. For the day, we are up about 8%. The market is up about 1.5%. For the year, we are up 201%. The market is up 5%. If you put $100 on January 1st, 2020, in Orange Capital Partners, you would have $301 and you would have $105 in the equivalent S&P 500 basket. So let's just right into the question, diversification or not. What does it actually mean to be diversified? And how should we think as individuals about fund managers that are diversified versus not diversified? First, let's talk technical. What does it actually mean? Diversification goes back. It's a historic concept that's been around in financial markets at least since the 50s, when Harry Markowitz, in his papers before that, wrote about that. And he did an analytical work at the University of Chicago about the risk reward of diversification versus non-diversification. And his conclusion was that you can optimize your portfolio by finding a few not very correlated stocks that then as a whole create a portfolio which is less risky with the same kind of return or higher return with the same kind of risk. So it's an optimization problem that is solved, and diversification is the word we're using in the financial markets ever since. Now, I think technically that's certainly correct, in a sense that you can say there are probably assets that you can mix together in a portfolio that give you some sort of what Markowitz called an efficient frontier. That means they are on a curve that gives you the maximum return for the same risk, or the maximum or the minimum risk for the same return. And vice versa, there's probably portfolios that are suboptimal. I would argue that's even today, that is probably still the case. Now, I would also caveat this. We at Orange Capital Partners are completely the opposite. We believe that there is conventional wisdom in diversification, that it's wrong, that it's misleading, that you cannot generate excessive returns by any means with diversification. In fact, diversification is a signal for laziness, lack of individual unique ideas, and therefore a recipe for suboptimal returns. And by the way, there is also the concept of fees that you have to put in there. So if you add everything together as an investor in the markets, if you give your money to fund managers that are diversified, you are most likely going to underperform. And that's because, number one, it's been decades now that we've been preaching diversification, and therefore also you have to kind of believe that everything in the markets has its time, and that sometimes that time is over. And I think diversification for a while now has been over. The same applies, by the way, to venture capital, where we believe the situation is even worse than in the public markets, in a sense that you have this spray and pray mentality of venture capital. Just throw a lot of money at little startups and then hope something happens. This has very detrimental effects on returns, but even much worse, I think, from a real economic perspective, it has detrimental effects on the actual startups. So this is just a side note. I would also stay away from such funds as a founder in particular, although it's a little bit difficult because the venture capital industry has a very tight grip on that kind of money, the money that goes to venture, to new startups, and therefore it's a little bit difficult to circumvent that. My point here, my advice would be to basically try to bootstrap your company and only take the money if you have a very clear view of what you want to do and you're not dependent on the goodwill or the advice or anything like that from those venture firms, because just by definition, because they are so diversified, they really don't have an incentive to help you uniquely. And this is the key word. I think when it comes to investing, it's like art. Uniqueness, the idea of you, the person of you is the key. You cannot outsource that. You cannot try to find something else out there that compensates for you. It's you. You have to develop your ideas, invest accordingly, and then live with them, because the main driver of returns, in fact, is not the right investment, the diversification versus non-diversification. The main driver of returns is to stay in the game for a long time and generate compound interest. That's what really makes a difference. If we can stay in the game for 20 years and compound interest, we can make a lot of money. If we stay in the game for 1 or 2 years, we don't make that much money. The difference, for example, we have compounded at Orange Capital Partners since our inception 16.3% compound interest rates for 12 years. If we had done 16% in the first 2 or 3 years, yeah, we would have made some money. But because we've been compounding for 12 years, we're already up 7.5 times. So our performance is 650% since inception. This is because we're able to stay in the game for a long time. And the only way we're able to stay in the game a long time, it has nothing to do with the particular investments. It has to do with us and our relationship to those investments and the way we deal with times when times are tough, when times are good. Are we adding? Are we not adding? How much leverage do we use? It's us. We decide how we survive. It's not the investment. It's not the market. It's not them. It's us. And therefore, in order to survive and generate compound interest rate, which is really the actual driver of returns, I cannot emphasize this enough. It's compound rate. The compound of rates is the power. We've all heard that story of the chess board, the power of exponential 2. We've all heard those stories, and it's all the same concept, which is the longer you stay in that type of game, the much more money you make. Another example, think about it this way. If you start with $100, you compound, let's say, by 20%, you make $20 in the first year. But you will make, in the 20th year, you will probably, I don't know, I'm just on top of my head, you will have $1,000, and the 20% will be $200. You will make a lot more in that particular year than you started with, but with the same compound rate. That's the power of compound. So diversification cannot help you stay in the game for a long time, because by definition, if you diversify, you're outsourcing the work, the relationship with individual investments, or in other words, the way to think about investments as a founder and entrepreneur, which is the only way you can really make money in the investment world, is if you as an investor are an extension of the founder. If you don't have that type of mentality, if you are invested in a company and you don't sweat blood and tears, at least vicariously, if not for real, if you're not concerned about how are they going to hire the talent that's needed, how are they going to develop the technology, if you just think, well, who cares, maybe they won't, but the others will, and some other company will, you will not get to the point of outsized returns. Now, maybe that's not your goal. I might be speaking now to fund managers that are in the, as I call, asset gathering business. That's very different business. Asset gathering, it has nothing to do with generating returns, making money. Asset gathering is a marketing, media type business where you're being paid by generating fees for investing money and keeping people interested or happy or entertained while you're doing that. That's a very different business. I would say people like Ron Barron are masters at that, or a lot of famous investors, Buffett, of course, they're all masters in entertaining their investors. And to some extent, I have to say Buffett has made returns, but recently, of course, he hasn't. And therefore, I would say he's a much more of a media company now than anything else. A lot of venture capitalists are turning into media companies because they really, with their spray and pray strategy, cannot outperform anybody else. So my point here is back to the question of diversification versus non-diversification. I think the fund manager that is concentrated is giving you a handwriting of their personality, which is, I am willing to do the work. I am willing to go through thick and thin to defend my investment, to live with it. And that's the only way you can have some sort of expectation that that investment will yield outsized returns. There's no other way. And I think I cannot emphasize this enough, because again, if you're concentrated, first of all, you're doing the work. And if you're doing the work, there's a couple of things that might go right for you. Number one, you might actually pick the next Tesla or Amazon or Apple. But number two, you will have a relationship with that investment that will allow you to stick around for a long time to generate the compound interest that you think you deserve. Take Tesla, our largest investment that we have had for pretty much the good part of this decade. We started around, 2013-ish. So yeah, 7 years. We've literally sweat blood and tears with that investment. And we stand at a point now where we've already 10x the money with Tesla, and we're looking for another 10x at least in the coming years. That is compound rate. That is real compound. And that's where you have to be. You can't, if I tell you now, you an outsider, just buy Tesla, you will not be able to withstand the pressures, the nervousness, the fear, the news cycle, all these things that come with this investment. And by the way, an investment, in our view, that makes money, it just has, by definition, has to be uncomfortable. You cannot have a comfortable investment that makes money. It's almost impossible. And to some extent, that is our concern. For example, we have Microsoft in our portfolio, which starts looking very much like a very comfortable investment, and it's almost a reason to be cautious. It's too comfortable. Our CRISPR index is not very comfortable. It's risky, it's volatile, it's idiosyncratic, there is news flow that is difficult to analyze, not complex, not convoluted, but just difficult, technical. That's not a comfortable investment. Microsoft starts looking like a comfortable investment, and that's almost, I wouldn't say it's a reason to get out, because sometimes it's fine. It's like if your wife is a beautiful, intelligent woman, great mother, good cook. I mean, sometimes things just line up. It's fine. There's nothing wrong with that. But you still have to question a little bit. Well, it's almost too good to be true. So you just question it. That's all I'm saying here. And we're very happy with our Microsoft investment. I just brought this up as like Intel is a very uncomfortable investment. It feels good. It's very uncomfortable. It's supposedly dying company. They have lost their market share. Nvidia is taking over everything. They're both armed. They're going to dominate. Them and Apple will dominate everything mobile, this and that. Yeah, great. Go with it. I bought some upside calls, long-term upside calls. I put myself in a position to take advantage if everybody's wrong. A very classical contrarian view of the world. And if it doesn't work out, it's fine. My risk is limited, but I like it. It's uncomfortable. It scratches. It itches. It's good. So to summarize, diversification, in our view, is a sign of incompetence. We are not recommending that for anybody, and we are ourselves trying to be as undiversified as we can. We have very concentrated positions, and we are also in a position to do that because we have decided mentally that lack of comfort, that uncertainty, volatility is part of what we want to live with. That's not something we're trying to think away or exclude from our portfolio. No, this is part, because nature is volatile. Nature, returns, they emanate from nature. Returns don't come from something abstract, some Markovitsian efficient frontier, abstract curve optimization. No, it's nature. It's people creating things. It's like evolution. And we are part of that as investors. We are generating wealth by looking for the next disruptive technology which is going to have large impact. This is the purpose of our fund. And therefore, we are not excluding volatility. We are actively looking for it and adjusting our own emotional behavior towards that kind of situation so we can withstand the investment for a long time, because the compound interest is really what makes the money. Thank you.